We continue IUL month. Last week, we talked about IUL as a diversification tool and a volatility hedge. This week, we're talking participation rates, the cap rates, and the spreads. Essentially, how are you going to get the credits based on the index options inside of the IUL? This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Becerra with Net Wealth Finance.
Carlo, let's talk participation rates. This is like the number one thing that everybody sees inside of their index options within the IUL. We see participation rates that go from guarantees of almost nothing all the way up to wherever they're at today and where they've been at in the past, which could be hundreds of percents. Shine some light on how they determine what your participation rate is in these things.
One of the biggest factors, and I've experienced this in my own policies, is the interest rate environment can impact how much budget there is for buying the options. So participation rates are going to be greatly impacted by basically what the yield is on the general account, on those secure assets the life insurance companies are earning, and that determines how much budget they have in order to purchase call options on the corresponding indexes that they use to get you those returns.
Exactly. Insurance companies are always on the hook for at least purchasing a call option with the budgets that they have. And that budget is determined by their general fund. Let's do a quick example of an options budget that the insurance company has to work with. And this is actually going to carry over to spreads and cap rates as well. Essentially, let's say the insurance company has $100 or $1,000, and 5% of it is their options budget. They're going to take 95%, and that's going to stay inside their general fund account that they expect it to grow back to 100% over the next year. And that will refresh the budget for the next year. So they have another 5% the next year to go buy options again. And then they're going to take that 5%, and then they're going to either go into the market or go work with some private banks to buy some call options.
We've spoken about what the budget is, and maybe that $50 or so, if we're talking about $1,000. Now, that might be able to buy more options in any given time when volatility is lower. So when volatility on the index, the underlying index, is lower, that options budget can go further. And so that combination of maybe a higher interest rate environment with a lower volatility environment can result in what will end up becoming a higher participation rate, because they can get a bigger return by having cheaper options and more money to work with in order to give you that participation rate.
So let's simplify that just a little bit. Essentially, a call option is going to cost X amount of dollars. And if the call option is cheap enough for the options budget, they might be able to buy more than one call option with that particular budget. If they can only buy one call option, that's going to give you a 100% participation rate. But if they could buy two call options, now you're going to get a 200% participation rate. So however many options they can buy with the budget is essentially going to determine the participation rate. So when the options are less expensive, we get higher participation rates. When options are more expensive, we get lower participation rates, or we may end up with a cap or a spread, which we're going to discuss here in just a little bit. But wrapping up the participation rate discussion, we have to acknowledge that insurance companies have made deals with private banks in order to get access to options that are not available to the general public. These options are going to be on volatility indexes and other things like the S&P 500 that it might be a 5-year option which allows for that options budget over the next 5 years to buy some type of uncapped participation rate. Really neat situation, and you really only get access to these from an insurance company.
And that's one way in which a lot of what we're saying here is some of these subsequent topics are going to be dealing with somewhat limiting your returns. These insurance companies have these uncapped allocations or these uncapped indexing strategies. By purchasing options on these non-regular market indexes or maybe some futures indexes that make those options budgets cheaper.
All right, I think that wraps up participation rates pretty good. Let's talk about caps. Caps is like the original index options that came in with IULs. Why would there be a cap on an index option? And we most often see this. Every carrier has an S&P 500 index option that has a cap.
It tends to be that if you're doing the regular S&P 500 index funds, there's going to be more expensive options on those. And so what they're going to be doing is various hedging strategies that will end up reducing what their total return can be. And so the caps will be determined by the hedging strategy and the cost for how much that is. That's why they have to reduce a total return and give you a cap on those indexing strategies.
So a simple way to look at this is if they're buying an at-the-money call option with the budget that they have, and it's not enough to buy the call option without selling off some upside. So let's say the budget is $50, but the call option costs $75. If we want to have uncapped growth, they only have $50. So instead, what they're going to do is they'll sell above, say, 10% to somebody else. So somebody else is going to buy a call option that is only profitable if the S&P goes above 10% profit at that date of expiration, leaving us or the insurance company with where the S&P is at today, all the way up until that 10% stop where somebody else gets the profit above and beyond that. And they'll sell that 10% option for $25. The $75 cost of the first call option minus the $25 of the one we sold gives us our budget of $50. That's an easy way to look at caps that are offered by these insurance companies. And here's a hint too of pulling back the curtain on how these things work. Since every carrier has an S&P 500 option with a cap, if you look at all of the different caps that are available among the carriers, you can see how much options budget they allocate for their IUL. Some are going to be higher than others because the S&P 500 is the most popular index in the world. They all buy from the same place. They don't need to go to a private bank to purchase these S&P 500 annual point-to-point caps. You can just go right into the market to purchase it. So some companies might have a 9% cap, while others might have a 10 or a 12% cap. That gives us a window into how much their options budget is for every other option that they're offering inside of that account.
And popularity of the S&P is really what makes it makes the options more expensive when compared to some of the other indexing strategies inside of an IUL. And so that's why if you're talking about raw S&P, pretty much in any IUL, you're going to see those caps on it because they just have to have these hedging strategies.
So it's not just popularity of the S&P 500, but it's actually how far the price can move in a given year. The S&P can move quite a bit. How much that option costs is going to depend on what is the possible move that it might make over the course of that next year. When we get to the volatility indexes, the amount of movement that they can make is limited, which is why the options end up costing less. And it ends up falling within a budget that we don't have to have a cap for. Now, there are other ways to get uncapped participation rates, and that brings us to the spreads.
So a spread is very similar to a cap. It's just the strategy that they implement is a little bit different. So rather than buying at the money or maybe really close to the money, they will buy options that are a little bit cheaper because they're further out of the money. And with that, you're giving up. So in order to get a return, it has to go over that point at which they bought those options for them to start earning money on it. And so whatever that number is, let's just say it's a 5% spread and the S&P does 15% in that year. Instead of 15%, you're going to get a 10% credit. And that's how a spread works.
So let's bring in a little bit of numbers just so people can visualize this. Instead of buying at the money call option, which we previously talked about might cost $75, but our options budget is $50. Instead of buying that call option at the money for $75, we buy 5% out of the money and it only costs us $50. But that leaves all of the upside potential from there for that call option. So this is an uncapped potential growth, but we have to get past that first 5% because we didn't buy that first 5%. We didn't have the budget for it. So this is one way that an insurance company can give you uncapped potential and stay within the options budget that they have to work with.
Yeah, an example I mentioned earlier was with 15%, but let's say the year it did 25%. That's going to be a pretty nice day, a pretty nice return to get, maybe 20% credit. So spreads can still be pretty great. I have seen them to be less common specifically for the S&P when looking at most of the indexing strategies.
Yeah, there are some companies that do offer spreads. More often, what we might see is just a lower than 100% participation rate. That could be a situation where maybe they're offering you 65% of the growth potential over the next year. In that situation, they might have had to combine the budgets of multiple IULs in order to have enough to buy one unlimited call option. So if we said it was a 50% participation rate, that would be two options budgets. You give 50% to one policy and 50% to another. And it accomplishes the same thing. Uncapped growth, you only get half of the credit. So there's a lot of different ways that they come up with to give you opportunities to make money. Now, a lot of people out there, a lot of critics of the IUL, look at the variability in the participation rates and the cap rates and the spreads, and they make it sound like the insurance company just wants you to fail and they want to take your money and they're the big bad insurance company. And that couldn't be farther from the truth. The reality is the insurance companies would love it if you made excellent money every single year because it doesn't affect their budget at all with how the index options end up performing. They've already bought the call options. They're already out that money. And if you don't want to participate in an index option, you can use the fixed account. They'll just give you the cash. So there are alternatives for the insurance company. They want to see you succeed because you're going to continue buying the insurance, which is where they make their money. They make their money selling the death benefit to you.
That really connects to what our last topic was with that volatility hedge. So in general, you can have some really great returns inside of an IUL, but all of these strategies that we just talked about are what protect your principal. So when the market is on fire or it's going down crazy amounts, an IUL can be shielded from that in terms of loss of principal. And that's the real power in these. And these strategies that we talked about on this episode are one of the tools in the toolkit of the insurance companies that enable that.
I think we covered this topic pretty good. Let's wrap it up. Do you have a call to action for our listeners this week? It's time for this week's call to action.
So if this episode was confusing, it might make sense to just go ahead and watch it again. Maybe check out some of our other content on these concepts. Maybe you're not super familiar with the concept of options. So there's a lot of content out there that is that can teach you about that. And it's good to have a little bit of an understanding of what they are. And feel free to book a meeting with one of us, and we can have a discussion to discuss what they are and how these tools are used by insurance companies for enabling that volatility hedge.
And I'll say, if somebody is interested in the IUL and you kind of want to understand what happens inside of this better, it will do you some good to go spend a few minutes and do some education on how call options work so that you can understand what's happening underneath the hood of this. We describe it pretty good in here, but we didn't start from the very, very basics of how they're going to go out and buy this stuff. That is better served by looking up call options and learning about call options and call spreads. Because if we got into that in this podcast, it would probably go for another 20 minutes. So I appreciate you joining us. Next week, we continue the IUL series for this month, and we're going to talk about all of the expenses inside of the IUL. You're not going to want to miss this one. It's one of the most important things to understand because high expenses in an IUL can really make or break the success of your policy. And with that, I'm your host, James Barber, your Oregon Cash Flow Pro. I'm licensed for life insurance and annuities across the country.
And I'm Carlo Becerra. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
Take care. We'll see you next time.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.